Welcome to the first episode of the Market Moguls Podcast, the show that dives into the world of the stock market and helps you navigate the ups and downs of investing. From brief overviews to in-depth analysis, our goal is to equip you with the knowledge and insights you need to make informed decisions about your investments. Whether you're a seasoned investor or just starting out, join us as we explore the exciting and ever-changing world of the stock market. We'll bring you the latest news, expert analysis, and strategies for success in the market. Get ready to become a market mogul. The major averages fell on Tuesday to round out a tough month for the stock market. The Dow Jones Industrial Average fell 232.39 points or 0.7% to 32,656.7. The S&P 500 shed 0.3% to end the day at 3,970.15, and the Nasdaq Composite closed 0.1% lower. Despite a solid start to the year, all of the major indexes posted their second negative month in three. The Dow ended 4.19% lower for the month and has dipped 1.48% year-to-date. The S&P 500 and Nasdaq Composite lost about 2.61% and 1.11% in February, respectively, but are still higher year-to-date. Those losses came after a strong start to the year for stocks. The S&P 500 rallied more than 60 in January. However, a sharp jump in Treasury yields this month dented investor sentiment for stocks, as traders feared that higher Federal Reserve rates would remain in place for longer. Now that that's out of the way, let's dive into some other stories. Precious metals. February was not a good month for gold and silver as they posted their worst monthly performances in more than a year. Even though these investments are often perceived to be safe investments during economic uncertainty, gold closed down 5.58% for February. That's the worst month for the metal since June 2020. When it lost 7.02%, silver had its worst month since 2020, ending February down 11.6%. It last saw a bigger monthly drop in September 2020, when the metal tumbled 17.84%. Non-invasive health monitoring has huge potential for Apple. Per Morgan Stanley, Apple is making progress in monitoring blood glucose levels without a blood sample, according to a recent Bloomberg report. If the tech giant is successful, Morgan Stanley said the development has the potential to be a huge disruptor. Disruption will likely take time, but given Apple has form in displacing incumbents in fields with large total addressable markets, we will continue to watch this technology and its speed of miniaturization, Morgan Stanley analysts wrote in a research note. The system reportedly uses lasers and measures the light coming back to the sensors to gauge the amount of glucose in the body's interstitial fluid. One of the biggest obstacles is how the components of the system can be shrunk down to be included inside an Apple Watch. The companies with the most on the line are Abbott Laboratories, Dexcom, and Medtronic. All three make continuous glucose monitors, but Dexcom is more intensely focused on the diabetes and health management market. Its stock tumbled last week when the news broke, and in recent trading sessions, it has yet to recoup all of its losses. It'll definitely be interesting to see what becomes of Apple's attempt of entering into the health industry. Buybacks below seasonal trends over the past month, per Bank of America. Stock buybacks are one of the core tenets of a bullish case for the market in 2023, as some expect buybacks to top $1 trillion for the first time. However, corporate America will have to pick up the pace to set a new record, according to Bank of America strategist Jill Carey-Hall. Corporate client buybacks accelerated but have been below typical seasonal trends for the last 4 weeks. Due to a strong start in January, corporation client buybacks year-to-date as a percent of S&P 500 market cap are tracking just below 22 records at this time. But new buyback announcements have still been sparse. Carey-Hall said in a note to clients on Tuesday, "One area where buyback announcements have been strong is the energy sector, where Occidental Petroleum on Monday announced a new $3 billion authorization for buybacks and a dividend hike." Analysts stay neutral on Zoom after earnings report. Pandemic, darling Zoom Communications posted better than expected earnings, and a solid outlook Monday after the bell. But it wasn't enough to get some on Wall Street off the sidelines. Earnings for the quarter came in at $1.22 per share. Adjusted, which is above the consensus estimate of 81 cents from analysts polled earlier. Revenue also came in above expectations at $1.12 billion compared with the $1.1 billion anticipated by analysts. While Zoom management issued a strong earnings outlook for the year, it also said growth would continue to slow as the company moves further away from its pandemic-era boom. While the top-line story remains weak, things appear to have stopped getting worse, said UBS analyst Carl Kierstead in a note to clients Tuesday. We remain neutral, rated. Just under 70% of analysts were neutral on the stock as of Tuesday, according to FactSet. Just over a quarter of analysts rate the stock as overweight or a buy, while just 6% recommend being underweight or selling. That's little change from where analysts stood in January. Credit Suisse was also neutral on the stock coming off the report, citing conflicting signals. The firm pointed to the company's contact center phone business and potential within the artificial intelligence space as areas that could help shift the company's narrative positively in 2024. Zoom continues to face the aftermath of the pandemic-related pull forward of demand, particularly in the online business, said analyst Fred Lee in a note to clients Tuesday. But owing to the company's deep culture of innovation, Zoom now has several potentially game-changing products in the market. Morgan Stanley also remained equal weight, with analyst Meta Marshall noting the international business, free cash flows, and enterprise as areas to watch going forward. What a crazy day in the market today. Now, before we end, we'll be doing some short stories. Number 1. Target released their earnings, which were higher than expected, leading many analysts to turn bullish on Target. Morgan Stanley reiterates electric vehicle manufacturer Fisker's bearish rating. Bernstein expects strong earnings from Costco, and Goldman Sachs downgrades Arconic, an architectural product manufacturer, to a sell after a weakening demand for Arconic's products in Europe, as well as an increase in a postponement of projects across the world. Interestingly, Arconic soared 20% today after Apollo Global Management submits a bid for a buyout. US 10-year Treasury bonds are at their highest since November, and chip stocks outperform the market. Cryptocurrencies such as Ethereum and Bitcoin are also going to end positive this month, despite a mid-month slide. Lastly, Citi downgrades Dick's Sporting Goods, and Dish stock falls after Bank of America's double downgrade. Ultimately, today's stocks slumped, but they're still up year to date. Thank you for listening. Market Moguls out.